Good morning, panel. I'll introduce the panel. We have Michael Andrews from Capital Markets International, Nick Axford, Global Head of Research, who we've met, Joshua Charles from Industrial, Josh Cullen, Capital Markets Institutional, Scott Gray-Spencer, Capital Markets Metropolitan Investments and Banking, James Patterson, Office Services, and Neil Proudlove, Retail. So I've just presented a fairly clear view of soft occupier conditions that we've experienced and which we do expect to continue over the next 12 months. The question to the panel is, what are we seeing as of most importance to investors given that softer occupier market? I'll start with Josh Cullen.
Look, I think from our campaigns to date... Is that now on? It's a good start.
There you
go. From all our campaigns and all our markets this year, I think it's quite evident there's a couple of key themes coming through. Definitely number one would be income security and WALE profile of all the assets. All our buyers are now looking, whether they're forward funding transactions, portfolio transactions or single transactions, all the buyers in the marketplace want 4 to 5 year WALEs now to get them through these softer times. Secondly, I think investors are becoming more astute and looking for future-proof assets as well in all the key markets. And when I say this, they're looking for the assets that can cater and have the flexibility for these softer occupier markets going forward, or can they be repositioned to cater for these markets going forward?
And from a industrial perspective, Josh Charles.
The industrial market, occupier market's actually quite good in New South Wales. As Josh said, it's really all about the tenant at the moment, and particularly in industrial about the length of lease. A lot of third-party logistics groups in particular are having pressure applied to them by their customers to take shorter terms, and they in turn are passing this along to the landlords.
And for retail, Neil?
Much the same for retail, lease covenant, lease duration and income sustainability. Looking firstly at the majors leases, length of lease extremely important, but also the rent structure. A lot of majors leases don't provide automatic income growth, and if you can't see potential for growth coming through, need to look very closely at those leases, particularly in the context of a diminishing real returns and what that does to the rest of the centre. Looking at the specialties, obviously lease covenant, quality of the tenant and the overall tenancy mix, how those three things come together to provide secured income going forward. Final thing I'd mention is a business plan for retail. In the context of a tough leasing market, it's too easy to do quick deals, the short-term stopgap cash flow measures. Retail lease legislation doesn't allow landlords to unravel problems easily.
And just from a banking perspective, Scott Gray-Spencer?
Probably most of the banks and the purchasers are now looking at CapEx requirements going forward, obviously impacting on future distributions. Obviously that, with the valuation support and short-term leases, might require higher levels of equity, so people and investors have to be very wary of that amount of equity required going forward.
Now there's a degree of what I presented today around changes in the Australian economy and fall in the Australian dollar, lower interest rates, impact of post-resources boom. So Michael Andrews, what are you seeing from foreign investors in terms of their views of the headlines on Australia at the moment?
Look, I think the resources story is more relevant to us here than it is offshore. The majority of foreign investment is focused on the eastern seaboard, so it tends to be about quality property fundamentals. If you look at Rains Square, for example, in Perth, we still receive very strong interest from both on and offshore investors because it was a core quality asset with strong underlying fundamentals. I think the greater impact's the Aussie dollar, and the dollar is now seen to be trading at a sustainable level and offering values, so we're already starting to see that have a positive impact in many of the investors that are making offers in the market today.
And the shifts in the domestic performance mix I've spoken about as well, have we seen any shift in domestic regional preferences from investors? Josh Cullen?
From a general perspective, you'd have to say no. I think if you break this down between core markets and the secondary markets, all the buyers in the core markets have been led by that stock in those markets. We've seen some big transactions in all our key markets this year: 480 Queen Street, Brisbane, King Square, Rains Square and Perth. 5, 6, 7 Collins, Melbourne, and more recently 200 George Street in Sydney. You'd have to say those buyers in those who have bought those assets have been led to those assets rather than the markets. Looking in the secondary market, the buyers are looking for reward for the risk in those markets. There's also been a lot of activity in those secondary markets. There's been some larger portfolio transactions in those markets as well. And you'd have to say the buyers have probably had the appeal of the size of the transaction in those markets. But on a national basis, and looking at your graphs and what we've seen today, Brisbane has been the market for choice of investors of late, and it's probably the one with the biggest question mark for growth and fundamentals in the short term.
And just from an outside-in view, Nick, just to build on your comments from earlier, what are investors saying about Australia in terms of perception of risk?
Yeah, I mean, I think one of the key risks obviously has been the strength of the Australian dollar, and as that starts to moderate and as you showed heads towards more potentially more sustainable levels, that risk diminishes. I think probably a bigger concern has been the potential impact of a slowing of China, which isn't just about the commodities sector, it's about the overall impact on the global economy and the wider Australian economy, and I think that is potentially something of a concern. But I think counteracting that, as you showed very clearly, the Australian market from a defensive point of view, if you're starting to worry about what happens if some of the unusual stuff we've been seeing unwinds, Australia's pretty well placed to weather that because pricing hasn't been pushed to the same extremes. And I think you really do have to bear in mind from a global point of view, if you look around the world, it's about balancing risk and return. And I think the income return you get and the overall profile of the balance of risk and return still looks more positive here in Australia than it does in many, if not most, markets in the world.
And I'll jump back to occupier markets for a minute, specifically around office. Obviously, Sydney's been pretty flat for 5 years, almost zero net absorption. James Patterson, have you seen any evidence from occupiers of plans to expand, or is consolidation still the main point of focus?
There's been limited business expansion over the last 12 months across all market sectors nationally. Certainly a major focus to date has been on consolidation, in some cases decentralisation. I think we're going to see a flight to quality and maybe even a two-tier market, certainly in the CBD. The sublease market currently is around 80,000 square metres, which is close to the GFC levels. Tenants are very focused on their total occupancy costs and looking at smart ways to improve their bottom line. This has led to many medium to larger tenants looking at their workplace footprint, supported by an upgraded technology platform, focusing on connectivity within their business and potentially an outcome of less space. I mean, as a tenant, CBRE is an extremely good case study. We occupied 3,500 square metres over 4 floors with 240 staff. We've consolidated into 2,600 metres with a sublease space for 600 for growth. Over 2 floors, we've now got 270 staff sitting at 210 desks. In a tough market, it's been extremely good for our culture, and through the creation of neighbourhoods, there's a positive impact on our internal communication. And it's very much a similar theme we're seeing when we're talking to tenants about how they want to use their space. All major occupiers in Australia are looking at the most cost-effective and productive way of running their operation. And a couple of examples. We've seen QBE, with the new CEO 18 months ago, they've moved their global headquarters into 8 Chifley. They've consolidated their workers' comp into Parramatta from the city. They've got a long-term strategic plan, potentially selling their head office in town, and moved some of their call centre operations to Manila. Freehills, from a legal perspective, and they're in the sectors that are a large user of space in town, they've reduced their footprint by 20%. They've moved away from a 70% office, 30% open plan to a 30% office and 70% open plan. So that's been, and a lot of the smaller firms are actually looking at how they better use their space. In addition to that, we are seeing a bit of a trend that with the increase of sublease, that there is a move from the suburban tenants looking at the CBD.
Okay, and incidentally, those sort of structural shifts that James was talking about around ABW and impacts are embedded in our sort of more subdued outlook forecast that I showed you earlier. Just a final point on the office space then. What's, in a soft market, what's the best strategy to manage the leasing risk?
Obviously demand is soft in all the markets, and it's very much at the moment driven by lease expiry. We're seeing a lot of the inquiries coming out a lot earlier than we've seen before. There's an increase in sublease in the premium and A-grade space. Examples of that flight to quality, which is driven by the fit-out and the commercial terms. As an example, there's a tenant looking at some space in Chifley sublease from UBS, which could be an effective deal at under 500 gross, which is not what the market wants to hear. The active end of the market is certainly the fitted-out tenancies, up to 1,000 square metres, with a price point of between sort of 700 and 850 gross. Currently, the first 2 quarters of 2013, we've seen over 110 inquiries, which is around 180,000 square metres, and 65% of those inquiries sit under the 1,000 metre bracket. Also seeing more spec fit-outs within the incentive package, which makes it simple and time-effective process for the tenants to move in easily. And within over 200 whole floor options in the market today, many landlords are looking at subdividing those floors and providing fitted out options to focus on immediate cash flow. And an interesting statistic in 2012, over 60% of the market inquiries stayed put. So really, obviously, there's got to be a very clear and structured retention strategy, which is vital.
And let's change the sector to retail. Neil, we've seen, I guess, for 2 decades, sector-leading returns, at least on a risk-adjusted basis, driven by that strong consumer spending environment that we had. Are we seeing a recalibration of return expectations in that sector, given the softer growth outlook?
I think I need to be quite careful in making generic statements, but yes, there is a recalibration going on. Required returns are being adjusted. We're in a low growth economy. Sales growth is difficult to achieve, and as a consequence, income growth is also difficult to achieve out of assets. Owners, investors are looking at medium to long-term cash flows, and they are repricing. Former benchmark yields or total returns, IRRs, of about 9%, very difficult to achieve now. If you're looking at prime quality, major regionals, super regionals, probably sitting in the low to mid-8s. That's from a valuation perspective. A true return, if you incorporate all the costs involved, probably sitting slightly firmer than that as well. Going forward, I think it's hard to see retail sales improving significantly in the short to medium term. Consumer spending habits have changed. In fact, consumer saving habits are at the fore at the moment, and internet sales also put a further driver into that market share.
Recalibration tick. Over to industrial. There's been a fairly wide range of performance drivers in that market, quite a diverse market. What are we seeing in terms of differentials in performance in the industrial sales markets? Josh?
Well, there's 2 overriding characteristics to the industrial market at the moment, and that is that the total numbers of sales are down. This year, in sales over $20 million, there's only been 8. Fast forward a few months and you'll see that number double, but only 8 year to date. The second characteristic is of those sales that are actually happening, we're seeing a lot more sale and leasebacks now than we have in the past. Think about Linfox at Erskine Park, $104 million in December. Think about Toll in Queensland, $84 million also in December, and the Pact portfolio, which is happening at the moment. Then there's 3 speeds to the national industrial sales market, and that really is the prime assets with long leases. And again, I take you back to that Toll NQX sale and leaseback in Queensland, and that was at 7.55%. And we really see that market sitting in that 7.5 to 8% bracket at the moment. Then there's the prime assets with shorter leases, and this is really where the opportunity is at the moment, and I'll talk more about that later. But we're seeing those sitting in between 9 and 12%. And probably the best example of that was a recent purchase at 4 Inglis Road, Ingleburn. This is a 45,000 square metre facility with 2 tenants and only 14 months to go on the lease. If we offered that 18 months ago, we would have had 0 interest. And we offered it 2 months ago and we had 5 really solid offers. And then finally, there's the secondary assets with 5+ year leases, and we're seeing those sitting at about 9 to 10%. So the opportunity really is in those prime assets at the moment with the shorter leases, the way that the leasing market is, with low incentives and pretty steady inquiry.
And in leasing markets, who's growing or who's expanding? What type of space are they requiring?
Yeah, look, the major retailers are really stirring it up nationally. Bunnings have taken 43,000 square metres in Eastern Creek. That's actually under construction as we speak. Kmart has completely reorganised their national warehousing strategy with a new 50,000 metre warehouse in the Port of Brisbane, also 50,000 metres in eastern Sydney, and two others soon to be announced nationally. Coles are also reviewing their national hub and spoke distribution network. They've taken space in pretty much every state over the last 18 months. Target are undergoing a major national reorganisation of their warehousing solutions, and Super Retail Group have just taken 43,000 square metres in Erskine Park, and that's currently under construction as well. But probably the most interesting part of this is the incentives. On existing A-grade stock, we're seeing incentives sitting around that 8% level, and we've even seen some examples where there's been no incentive at all, and that's purely based on the competition for this space. But if you go back to the design and construct build to suits that I was just talking about a moment ago, we're seeing those in New South Wales sitting around 10 to 15% for the larger deals, and there's even been examples of 20 and 25% on some Victorian deals.
Let's turn to debt sales market. Scott Gray-Spencer. What trends are we seeing in that market? Are there more coming to the market, and who are the main players?
Well, obviously there's been a significant amount of debt sales, and it's a sub-market unto itself, probably 4 to 5 billion in the last 24 months. The major players obviously being Goldman Sachs, Morgan Stanley, Brookfields, through the sale of the Bossie 3 portfolios, Lawson, Patterson and McKellar. Other players in that space are the new entrants, Pacific Alliance Group, Pepper, and even on some of them Investec. So there's plenty of people out there looking for these debt sales. I think the majority of the major ones have been done. From a banking perspective, Deutsche have been very aggressive and basically been lining up to finance most of these sales, so they've taken a very strong position in the marketplace. From that point of view, it's interesting, with the drying up of these debt sales, I think you'll see these strong groups like Morgan Stanley and Goldman Sachs looking at the leveraging of just direct property. There's a nice amount of money for them to be made on those by their leverage. So from that point of view, less going forward. Probably the major ones have been done, and they were the main players.
Finally, a 1 minute wrap on each sector. From your observations of market sentiment, what's your outlook for the next 12 months? Let's start with institutional. Josh Cullen.
Looking forward, I don't think we'll see things change. I think the weight of capital will still be coming here. It'll be domestic and offshore. It's all been chasing prime and core assets. That will dry up, without a doubt. There's limited opportunities in those markets there. But in saying that, if there was something offered, a core or prime asset in the markets, you'd expect significant interest and very tight yield compression. But dropping down into the secondary markets, if buyers can't get the core assets, will they drop down into the secondary markets? With the fundamentals we've seen today, they'll want that reward for the risk they're going to those markets.
For industrial, Josh Charles?
Well, firstly, we see the current leasing conditions continuing on their current tangent. Demand staying reasonably strong, and incentives really stabilising around that 8%. Secondly, as I mentioned earlier, we see that increased demand for those prime assets with shorter leases. Again, go back 18 months ago, there was next to no interest for those assets, and we're seeing the people that have recalculated their risk to accommodate those assets and understand the leasing market really seeing significant yield compression. And finally, on the prime assets with long leases that do come to the market, we're seeing those yields in Q3 and Q4 stabilising towards 7.5%.
Neil Proudlove for retail, what's the outlook there?
Investment sentiment to retail still remaining strong over the next 12 months, being driven by significant capital, both from onshore and offshore. Offshore being direct investment and co-ownership type structures. We see that continuing over the next 12 months. The major sector of interest is the sub-regional sector, where yields have firmed. Yields are likely to firm a little bit more there as well. Up until late last year, buyers were finding it difficult to price risk in assets, and as a consequence, many failed to sell. That's changed significantly in the last few months. Of real interest regarding that is the recently announced Pacific REIT IPO, $450 million worth of sub-regional centres. How that's received by the market will provide a very good litmus test to future demand for retail over the next 12 months.
Office services, James?
Yeah, I think it'll be very tough for the balance of 2013, 2014. Patchy demand, very much driven by lease expiry, as I've already said. Steve and I have spoken a lot about what's going to stimulate the demand, and hopefully with the low interest rate environment over the next 12 to 18 months, some business confidence, employment growth, we should see some demand in office space Q4 14, Q1 15. Obviously, as I talked about earlier, the impact of ABW, it's having a more and more impact on the medium and larger companies considering that style of workplace. The incentive levels will remain high. There'll be pressure on face rents, even with the increased incentives. I think the pre-commitment market, there'll be some pressure there on getting more than 50% pre-commitment in most of the markets, both in the CBD and the suburban market. The sublease market will remain very active. There'll be strong demand for quality sublease, driven by its price point, obviously dependent on its term. Strong activity in the fitted-out suites under 1,000 metres, and owners are being very flexible on the short-term deals, offering options. And I think there's the opportunity, if you can do a deal today, which sounds like a real estate agent, I think, and a sensible deal, it's better to do it today than do a deal later in the year.
Michael Andrews, the international sector, what do you expect there?
Look, I think it's going to be similar to what Josh was saying. We'll see continued interest in core CBD stock, predominantly Sydney, Melbourne, long-term Wales. We've already seen some very aggressive above book value offers for trophy assets in Sydney CBD, and I think that will continue because our yields are comparatively strong regionally. I think secondary will take a little bit more time for the foreign investors. We have to spend some time educating them on those markets and the value that they can get out of that market. But interestingly, what I think we'll see is a continuation of co-investment and amalgamated investment with local managers. And I think that will start to skew some of the graphs that you put up earlier because we're seeing a lot more co-investment there.
Thanks. And finally, just from a banking markets perspective, Scott, what do you expect there?
I think it's safe to say that there's a correlation between what the banks want to lend on and what the buyers want to buy, being prime, new long-leased properties. There'll be limited chance of larger assets, distressed assets hitting the market. I think you'll probably see more B and C grade assets hit the market in the distressed space. Obviously, foreign groups that don't need to borrow as much are very strong players, and they'll get their equity and debt pretty easily. I think you'll see the privates under 30 million probably come back into the market due to the low interest rate environment, so they might tidy up some of that stock. Probably the interesting point is the equities market is that equities was very strong in the first half of 2013. I think it's probably not going to be as strong in the second half because a lot of people have raised and have bought, so that'll be interesting space to watch.
And the last question for Nick Axford, I think of interest is Australia in the global scheme of things represents about 3% of global capital inflows, fairly small. It's been attractive in the last 3 years. I guess with the shifts in the world markets, do you see any challenges for us in Australia?
No, I think people are always going to be looking to buy here for two main reasons. Firstly, because we need an excuse to be here for major international sporting events, and secondly, as I said, Australia, everybody would like the market to be a bit more, a bit larger and a bit more liquid, but fundamentally the market is mature, it's transparent, it ticks all the boxes from a core product point of view. And if you look at this part of the world, Asia Pacific, I think there is going to be structural pressure on core institutional type product. We're going to see massive growth in savings coming out of Asia, Southeast Asia. We're going to see a greater maturity and a growth in the investing institutions. The demand for core product just out of Asia is going to grow far faster than the market, the available stock of core product in Asia is going to be able to accommodate it. So Australia is bound to be a market a lot of that capital is continually going to target. If there is a risk, I think it is simply that with strong domestic institutions and continued growth of super funds, we could see a lot of that product being locked up by long-term investors and simply a problem with people getting into the market. But I think there's no question we're going to see, for a good while yet, we'll see plenty of people continuing to look at the market here.
Thanks. So I think there's probably three things that have come out of that for me. There was a lot of discussion about quality of tenant, which I think is very relevant in the growth environment. There's still a lot of discussion about prime assets. We expect they'll continue to perform well here. And based on the research evidence, based on the panel's insights, It really looks like later in 2014 before we start to see any real momentum in the secondary markets. So thank you to the panel.